Ladies and gentlemen, it's a great pleasure. In the name of SIA, we welcome you warmly for our quarterly update call. This call is being recorded, so if you all agree, please accept that fact. You can put your camera off, but it's usually just the recording of the person that speaks. We have still people joining, but I think we should not punish the ones that are very punctual. We have a lot on our agenda, so I think we should start immediately with the first part, which I would like to pass on to Marcos. Marcos, please.
Yes, thank you, Alex. Good morning, everybody. Thanks for joining the call this morning. In the slide number 2, you can see more or less how the presentation is divided. I will take the beginning. So I'm going to jump in the base case scenario we have for the next few quarters in the slide 3. So you can see that recession now is everywhere. Possibly is the most repeated word in the world. And I wanted to mention the phrase or the sentence of Samuelson again that was saying that economists have predicted 9 out of the last 5 recessions, because everybody's anticipating a recession and nobody really knows what is going to happen in the next few quarters. But the message here is the important message for us. Alex, if you can move to the number 3, it's that recession or not, this is a little concern to us because we have an excellent book, both classic and natural resources, and they will bridge any recession without permanent losses. And also, it's important to highlight what Warren Buffett often states is that he hopes to see a lot of recessions because these moments is when Berkshire Hathaway makes the best investments, in periods of economic turmoil, and is what we plan to do. If there is a recession, we will buy like hell, very cheap companies. And anyway, the book is fantastic. I will enter later on the impact on this in the intrinsic value. Let me go to the slide number 4. I will touch very briefly on 3 of the main topics that everybody is scared of. First is inflation. You can see what the consensus expects, and most of the, educated people and economists are predicting is that inflation will start fading by the end of the year. So everybody is very scared about inflation, but half of the current inflation stems up from high energy prices and high food prices. This will normalize at high levels, but they will normalize. They will not keep up increasing. Supply chains are improving. Food prices should also normalize next year because higher prices tend to lead to more planting. So it's a cycle which is shorter. Fertilizer prices are stabilizing also at high levels. Europe doesn't have really a tight labor problem like the US. So Europe should be more in control of inflation next year. And obviously higher rates and the slowdown in the economy will have an impact in inflation. So, inflation is now in the front page of every newspaper, but next year should be better. We are not seeing 0, but we are seeing much controllable inflation in 2023. In the next slide, another of the topics that everybody is scared of is China. You can see here in the slide how the PMIs are starting to rebound. There's plenty of measures that the government is implementing in order to support the economy. So really, we are not scared about China. We don't see a bubble in housing or in property. We don't see a problem in the banks. So we think it is manageable. We've seen that in the past 15, 20 years, how the government manages the cycle there. It's a 2-year cycle. It started for the property cycle started falling just in June 2020. So now it's starting to rebound. The problem is the COVID. So they are trying to manage the COVID, and this is kind of delaying a little the recovery. But in our opinion, China is troughing, and in the next few quarters, we will have positive news, which is very important for the global mood, I would say. The final topic I wanted to touch on the macro or big picture in the slide 6 is the energy prices. You know very well our opinion on energy prices. They will remain high. Basically 4 reasons: lack of investments since 2013, the energy transition, which is having a lot of impacts, huge increase in demand for some commodities, and they are deterring investments in fossil fuels, which is, in terms of coordination, it's an issue. Then ESG, ESG is having an impact in new permits for mining. It's very complicated in terms of environment and also in terms of on fossil fuels investment on CO2 emissions. And finally, the fourth point is the invasion of Ukraine that I will jump later on, but basically Russia is 10% of the worldwide oil and 15% of the gas, and also between 5 and 10% of most of the metals. So really, and a processor. So they have refining and processing industries. So this is an important new item to add to the energy kind of base case. So energy, high prices for the long term in our view. So where are we? And we changing for the first time. If you recall, we were talking about the last phase of the upward cycle. So this is now over. We are in a slowdown. So basically COVID is in last legs, in our opinion, globally, but China needs to manage through it. Inflation is peaking, so we commented that. But the cycle now, it's an economic slowdown. We don't know if this will go to a recession or not, because this is a dynamic model, so nobody really knows. But the indicators we are tracking, earnings downgrades, inflation and rates, industrial PMIs, and China are still delta negative. So I mean, we are still in a fighting mode versus the macro. So the scenario now is a tough scenario for the next few months or quarters in order to reach the bottom. This phase of the cycle is normally negative for value and for cyclical, so this is true. But both books, our portfolios are doing very well, and they are built in order to pass this kind of slowdown. I'm going to jump into the classic. We'll go a bit faster because most of you know more or less the performance. It's up 15% to mid-August. This is a little bit late because we closed the presentation a couple of weeks ago, but now we are plus 11 more or less year to date, which is good versus every index almost. It's in line with the target. You know that we have a target for this year of 5.75 euros per share. So this is very much in line, nothing to comment. Best sectors, industrial, salmon and energy. Worst sectors, technology, infrastructure, cement and mining. Why? Because these sectors are very exposed to the fear of recession. So recession is still a fear. We don't know if this is going to materialize or not. Energy is still a large part of the classic. It's the big kind of driver or one of the big factors of the classic. Jumping to the slide 10, IRR and IV. So the IV has the intrinsic value has risen substantially. I was very surprised. The team was very surprised by this because why the IV? You know, a couple of years ago, the intrinsic value was around 600. Now it's 880. And, you know, we have realized that, the two crises we have had in 2020 and the correction this year in 2022. So in 3 years, two very big corrections have helped us to buy on the cheap. So we are selling companies or reducing weight on companies that are doing well and investing in very cheap companies. And this is helping a lot the potential upside of the fund. So, you know, average down is doing its work with a caveat. And I wanted to say, so, you know, average down works if you don't make mistakes, obviously. So, you know, it's long term, but we think that the book now with these corrections is stronger than ever. In terms of internal rate of return, it is around 15% now, which is on the cheapest side. You know that the range historically for 20 years has been 12 to 17%. So if the fund goes down and the market goes down, we don't know, but this can happen. I mean, this IRR will start to be very, very, very interesting. Just I mentioned with this IRR, if we don't make mistakes, let's say we offset mistakes with successes, the IRR after fees would be 13, 14, which means that we should double in 5 years. So, you know, I want to highlight this 1,000 euros per share in order to, you know, motivate all of us and see if we can reach this target in 27, 28, 29. We'll see. One important thing here, don't forget the marginal combination of compounding and long term. So being invested and compounding at double rate does magic. In terms of very fast on the where are we exposed, it's basically, this is the top 10 holdings. You can see them. Good quality, good management, good strategy, clear strategy, balance sheet. So the same as always. I want to show it this again because half of the book is really concentrated in these 10 names and very diversified across sectors. And just one comment here, we realized that 5 of the companies are in trouble according to the market. So Grifols, ISS, Sodexo, Unilever, and Reckitt Beckintzer, have a negative opinion from the consensus. Our strategic analysis suggests strongly that these companies will overcome the current problems and make very good returns for us. So this basically is the picture of half of the fund in a very recent picture. I'm going to go very fast to the investment case of the quarter. You know that we like to enter in detail in one company per quarter. In this case, it's Cenovus. You know the company, it's a Canadian oil sands company, so oil company, and very briefly, fantastic assets, low cost, very reliable, long life reserves. These guys have more than 50 years reserves if you adjust them. Management is fantastic, very aligned with consensus, with minority shareholders. The culture is good, focusing on cost and returns, and it's a very resilient, from cost, from how they invest, how they manage the balance sheet. It's a very resilient company. In the next slide, you can see a little bit of extra potential. They can grow more than what they say because they have 50 years of reserves. So not every company can grow, but these guys could do. If oil prices remain high, they can grow. They have very good margins and returns. At oil 80, which is below the spot price, they're generating very good returns, double-digit returns, and the balance sheet is fantastic. Don't forget that in this business, a sound balance sheet is key because the business can be cyclical from the supply side, long-term, from the demand side, as now short-term, because you can have a kind of recession anytime. And in terms of valuation, I will jump this one, but let's go to the 16, Alex, if you can, just to explain you what is the valuation of Cenovus. This is a slide from the company. If you see on the right, on the gray, at 75 WTI, which is the US pricing for oil, these guys will generate $33 billion free cash flow after CapEx, after everything. The market cap is 35. So, in the next 5 years, at oil 75, which is below the spot, because at oil 100, this will generate probably 45 billion, we are going to get the full company and then the rest for free. So this, I wanted to show how cheap the sector is, how cheap the company is, and why people still hate the sector. Nobody's convinced that oil will stay here in terms of demand for the next few years, and the sector remains very, very hated. That's for my part for the classic and the investment of Cenovus. I will hand over to Urs, I think, that will talk about macro and natural resources.
Thanks, Marcos. I just want to have a few quick words why I think this autumn could offer very good buying opportunities, not just in our fund, in many assets. Here are just a few statements of the US Fed boss. We all know this, but also the last one is what nobody talked about. And that's maybe a similar choice, not as extreme as Mr. Rauchenstein had to choose 100 years ago, which was a hyperinflation or revolution, but we could be less extreme. But at the end, it's the economy or fighting inflation, which will come down, as we have seen. Maybe on the next slide, Alex, see the reduction of the balance sheet of the Fed. And on the next slide, there's an example of the Japanese central bank. Approximately a third of the announced balance sheet reductions really have been made. And we can, obviously, we all know what happens. The economy is depending on cheap funding, all the governments, cheap credit. I recently listened to Partners Group, all the problems we see with exit of this private equity. So the whole economy cannot afford really declining collateral. So we will see what happens this autumn. Maybe the next slide, Alex. So we see, this is a sentiment survey. We see one of the most bearish sentiments towards stock markets in the last 20 years. We see one of the highest cash positions of investors in the last 20 years. Usually these people are always wrong, particularly on the low sentiments are quite a good indicator. Maybe on the next slide, Alex. This is a bit particularly what people make bearish in the mining industry. Obviously, we saw this cost inflation, which probably is going to ease as well. And people take this into the models. Then we have lower production, which they take into the models as well. Of course, I mean, we cannot have presentations and always talk about the underinvestments and then expect every company is producing more copper and so on as expected. So, but the outcome would also be that maybe one should adjust the supply models of the total industry, but and obviously subsequent the prices you put into the models. So that has not been done. So that was the same like that happened in the last cycle, and I think that explains a bit why people are extremely bearish, particularly on the cyclical part of our portfolio and industries. Maybe the next slide, Alex. We see something here in the copper market on the COMEX, where you have to qualify yourself if you're a hedge fund and a commodity trader, a refiner, etc. And you see the green, the white line is the positioning of the commercials, of the speculants, and the yellow one of the commercial. And you see a situation which hardly happens ever, but maybe every 3-4 years, that the commercials are becoming net long in the copper futures, and this is a completely unnatural position, because these are the Glencores of this world, which have a natural supply given their mines or offtake agreements, and this is hardly virtually always a good buying opportunity. And the last time this happened was, I think, end of 19, and afterwards the copper price more than doubled. So this is one of the most extreme positionings we have ever seen. And I don't think this will be that different this time. Similar something in oil. We have seen the biggest liquidation of the financial industry in the financial oil market. And it's on the lowest level now since whatever, 10 years probably. And in a normal market, which would be oversupplied, I think oil would be back to $50 with this huge liquidation of the financial speculation. And then this is also very important. The US, this is officially announced, you know, they sold down the strategic reserves to a 40 years level now. And it's officially announced by the White House that it is to control inflation. Don't forget, we have the elections midterm in soon. And it's also officially announced that they will have to rebuild it and will rebuild it. So I think we have an extremely negative environment for oil prices, meaning a slowing of the economy, a complete collapse of financial speculation, and the biggest release of strategic oil reserves. And I think the chances are pretty good that could reverse, let's say, into the beginning of next year, all these three factors. Maybe the next slide. So maybe that's something about the central banks. You know, I would advise you, this is something I took from the homepage of the Cleveland Fed. So that's not it's not my words. So there's a history of central banks, you know, from the Riksbanks to today, and they were always founded to finance government deficits and to finance the government. And it's always the same, you know, normally the government is financed by taxes, but when it's too much, you can't raise taxes anymore. And this is quite funny, you know, if you read on the official homepage of the Fed, what is really the mandate of the Federal Reserve? And it is obviously to expand the balance sheet. And this is what they did since the last 100 years. And you know, counter these recessions and so on, not just the Fed, but everybody. So let's see if this time is different. But I would assume if the pressure gets too much, particularly after in autumn, then I wouldn't be surprised that we could see something different, that the market has priced in with its extreme bearishness and extreme negative position, particularly for the cyclical and economy-related part of the markets. And then this is something funny I found from the European central banks. You know, this is what they announced with this TPI. It's always a complicated expression that nobody understands. Quite funny, you know, that they say we have to fight a deterioration of financing condition not warranted by country-specific fundamentals. So meaning like a country like Italy is obviously completely unjustified to having to pay a little bit of interest rates because it's such a good government that you should lend them money for free for all the time. And of course, if you want to raise interest rates, I mean, that's the nature of the thing, that it's getting that it's a deterioration of refinancing conditions. That's the nature thing. So obviously now you talk about this, and as soon as it would happen, you start fighting in it. And actually the last part of this, it's, if you really read through it, it's already structured that you can go all in soon, because meaning that you can buy up virtually everything regarding every debt paper from private issuers as well from the public sector. And if the pressure gets too much, we will see something like that. Just imagine, I just read that 1.5 trillion collateral is on the problem in the energy markets, and we do already see that governments have to bail out this stuff. Margin calls, 1.5 trillion. Switzerland announced yesterday, I think, 4 billion loan to one of our utilities. So let's see if we can play the hard way, or if not, governments have to again bail out everything like they always do. Maybe on the next slide, Alex. And this is something which we could see this autumn as well. It's just a paar headlines, you know. We know all the problems about the sanctions. I just want to tell you that in regards to coal supply, virtually whole Western Europe relies virtually 100% nearly on Russian imports. I mean, 80%, 70%. If you look at uranium, which is a longer term thing, but it would be the same, it's the same. And in the LNG stuff, it's very intelligent that we buy LNG, which Russia sold to India and China, and buy it back now from these countries. And the reason why the gas storage was filled up a bit is that a lot of the large consumers have shied away from their gas usage, meaning because gas prices went up 5-fold, it's cheaper for them to resell the gas to the utility instead of producing aluminium and steel and all these things. And virtually what this means into this winter, it's not about having a shower, which is a bit colder. It's a complete collapse of the producing industry. And this is already announced. If you look at the heavy industries like zinc smelting, aluminium, steel, of course, we already see these announcements. And don't forget, you know, of course, the electricity consumption is 60–70% by the industry and not by the households. But you know, the households are employed by the industry, and at the end they both pay taxes to the governments. So let's see what's going to happen into this winter. But I think the chances are pretty good that both of the most negative things what experience the market, meaning tightening of central bank and this whole energy crisis, could be resolved, because I think the only alternative would probably be people on the street. And I think the chances are pretty good that we see some fading headwinds from both sides, particularly for our cyclical part of the portfolio. Thanks, Alex.
Okay, I will be back to the portfolios.
Marcos, can you please take over?
Yeah, can you hear me, Alex?
Mm-hmm.
Perfect. So let's jump to the Natural Resources Fund.
Marcos, maybe you could take over now.
Okay, so on the Natural Resources Fund, we had a very good 2021, as you all know, plus 40%, and the fund is up like 14% year to date. So another good performance. Basically, the energy part is doing very, very good, like 45–50% increase year to date, followed by agri-food. So salmon and some other companies are doing fine. On the negative side, mining has been very disappointing this year in terms of performance, and infrastructure. As we commented before, this is due to the recession fear. Just let me highlight that our 3 Russian companies are still valued at 0. But they are trading at higher value, so there is probably some potential to catch up some points in the future. Just highlighting again that this is just the beginning. The natural resources cycle has just started, so we really believe in a long-term super cycle, because it is going to be very, very difficult to develop new supply. So it's relatively easy. On these 4 things that we mentioned: low investment, energy transition, ESG, and Russia. Let's move to the look-through of the fund. Our exposure now remains more or less the same. Half of the book is in energy, oil and gas, and half of the book is in basically in metals, infrastructures, and agri-food. So nothing really changed. We are very bullish copper, nickel, and uranium. Lithium is there a little bit, so if prices go down, we will increase a little bit more. Cement is super cheap, it's a very hated sector. Salmon has done very, very good, so I will comment now a little bit more on that. But basically, on the right hand of the slide, you can see how we want to create value here. Scarcity of the commodities, so we look for supply issues, not demand. No majors, no startups, tier one assets, safer geographies, production. So startups are too risky, good balance sheet and good management. This is basically the philosophy behind the fund. Intrinsic value, we found the same as with the classic. Basically, this year we have been very lucky because copper has gone down a lot and other metals, so mining in general, and oil has gone up a lot. So we've been able to rebalance a little bit the portfolio, and the consequence is easy. The intrinsic value jumps a lot. So sometimes it's very difficult to do that because there's a lot of correlation, but this time in natural resources, we saw not a really high correlation, which is helping us to build a much better portfolio. Again, the intrinsic value doesn't include the Russian stocks, and all valuations are made at mid-cycle. I always highlight the upside on the peak cycle that we are going to play here. So we think that the fund can reach 300 euros in 3, 4, 5 years, because if the cycle materializes as we see, we will go to much better earnings at much better multiples. The IRR, by the way, is very similar to the classic, is 14.5%, 15%. Let me just go briefly to three of the main, three of the main topics I want to highlight here. One is oil for a couple of minutes, then I will jump in copper and then in salmon, but pretty fast. Brent peaked $130 per barrel, 140 in March. From then, the barrel is down to levels of between 90 and 100. Two reasons. Saudi Arabia is producing at maximum capacity, raising 1 million barrels a day. And what Urs was commenting, the sale of strategic reserves, which is another one. So 2 million barrels more on the supply side have more or less balanced the market. This is why the oil price is down, also because a lot of people are fearing the recession, and this normally has a huge correlation with oil price. Whatever they say, you know, the spare capacity is at all-time lows, is around 2 million barrels a day. This is IAEA saying 2 million barrels a day is the spare capacity, only 2% of the capacity, which is, you know, really, really tight. Just one comment, Saudi Arabia full capacity or almost full capacity, and the strategic reserves will stop releasing, will be released in October. So these two factors will fade. And in the next slide, you see what will be more or less the base case scenario for the next quarters. Inventories will resume their drawdowns. So inventories will continue to go down the next few quarters, and the oil price will follow them. As usual, short term, oil price follows inventories, which is supply-demand balance, basically. So this is the short term. Long term, in the next slide, the truly fundamental change, this is important to split what is short term, what is long term. The really important thing here is the Russian invasion. It's the main change to the fundamentals in the sector, because Russia is one of the biggest producers of oil in the world. So what will happen is that CapEx will fade. Not only, you know, international CapEx, I don't know, the majors, the Schlumbergers, these guys are investing a lot in Russia and they are exiting, but also local CapEx will be fading. So we have several years where the production in Russia will probably stabilize and maybe start falling due to declines. The rest of the more main variables, the core variables, remain unchanged. Lack of spending, increasing declines, low spare capacity, as we said. US production shale is very, very disciplined still, and demand is slowly going back to pre-COVID levels. So there's still, you know, a gap of demand that is not being filled, that will be filled in the next 2 years. And this is the question I ask ourselves, you know, everybody says that at $100, the new projects will be feasible, technically feasible, so the incentive price will work, we will have more projects. But look, you know, if you go to a board and you propose a long-term project, 15 years more, with billions of investments, fear of peak oil demand, sustainability issues, CO2, maybe 100 is not enough. So this is a question mark that we ask ourselves and we debate a lot, because all the models of everybody are done with 80, and maybe 80 is not enough. It should be 120 or 130 or whatever it is. So, you know, this cycle looks very, very strong for the oil. Let's move very briefly for copper. I wanted to highlight something that I was really amazed from the Q2 results from Atalaya Mining. I mean, these guys, with an average price of $3.5 a pound, they make just break even. And this was due to huge cost increase, electricity, explosives, materials, everything, diesel. So we asked the CEO, hey, what price do you need to make money? Because this cost, some of them energy will remain high. And they say, well, you know, we think that 3.5 is not enough. And they said, the CEO of Lavandeira said that the world needs 5. So nobody, I tell you, is using $5 a pound in order to make the projections and the valuations. And we think this is going to be, you know, the correct number in the next, we will see it in the next few years. Two main issues, if I can repeat that. One is structural issues, regulation and taxes and licenses. You see problems in the mining everywhere. It's not only Peru with the, you know, with the new president. It's not only Chile with the constitution and the new tax regime. It's also the US. It's also Spain. It's also the UK. So everywhere, you know, the mining sectors is not really being helped. And the second issue is the low grades. I mean, if you follow Chile, it's amazing how grades in Escondida and most of the Chilean mines are going down. And this is important. It's going to be spread all over the industry. So, you know, in the end, if you look at the curve in the next slide, we try to follow the new projects, and we see new projects 23, 24, but after 25, there's no projects, no greenfields, not even brownfields. And at these prices and these costs, it's going to be very, very difficult. So you can see here the gap. There's an 8 million gap of a market of around 30 million that needs to be filled, and copper is in the base of electrification. So again, we are very, very bullish long-term in copper. Let's go to salmon for 1 minute. We were in Bergen in the conference, fantastic conference. And again, you know, this hasn't changed. Demand is growing 7-8% per year, very good product, very competitive at fat prices, obviously, and supply is extremely limited. So very difficult to get new licenses. And only new licenses and post-smolt strategies, which mean putting fish a bit larger in the sea to shorten the cycle, leads to maybe a 4% growth in the supply side, best case. And there's no way to bring new supply. I mean, there's two ways: offshore farms, which, okay, it's long-term, not really scale now, little volumes for the next 2 years. I'm not going to enter in the fundamentals. And onshore farms that if you do numbers, you run basically, because with the energy cost now, I mean, I don't understand how a onshore farm will be profitable. They need much higher prices. It's very difficult to compete with the sea. So the sector is fantastic. It has done very, very well, and we are kind of reducing a little bit the weight. What we were saying, reducing here, investing in copper, which has been down a lot. It's going to take the intrinsic value much higher. We will do it gradually. We always do gradually. We are slow people. We are slow and boring people. And you look in the slide 39 here, how the industry plays for the next, for 22 and the next 12 months. So Contali, which is the expert in the sector, they expect a very modest supply growth in the next 12 months, around 2%. So again, high prices in salmon. There's no salmon. Just to sum up here, before handing over to Carlos, natural resources, long-term super cycle. We are witnessing two cycles in parallel: the traditional boom bust from the commodities and the energy transition. And to this, we are at ESG, as we mentioned, is another problem. It is obviously it is correct, the philosophy. The problem is the implementation. There's two cycles that are different, so we need to split. The metal cycle is very easy because it's low supply or limited supply and huge demand. And the energy cycle is a bit different because it's limited supply and sticky demand. So people think that fossil fuels demand will fade. No, it's going to take a decade or more. And final comment, current valuations are low, so we have plenty of upside here. And I hand it over to Carlos, that is going to deep dive in the energy space.
Okay, well, thank you. Yeah, I don't want to go over again whether the recession, the inflation, you read about that every day in the newspapers. So I don't think we can add too much there. But I remember I was reminded of a very famous quote or phrase by Ernest Hemingway in The Sun Also Rises novel, when a friend asks another friend, how did you go bankrupt? And then the answer is, well, two ways, gradually and then suddenly. Well, I think this is how we have gone bankrupt in energy. We have been, when I say we, I mean at SIA, and of course many other people, but we have been saying for years, there is enough energy, not enough, people are not investing, and nothing happens because, you know, it's like going bankrupt. You know, people put up with you for a long time. There are always some things to sell. You can still even bring in the Iranians, you know, even if the regime is probably not, you know, somebody who should be sitting at the table, but you can bring them in and, you know, get a little bit more oil and this and this and that, and eventually you go bankrupt one day. Now, it could be the war in the Ukraine, it could be that you can pass the slide, it could be the half the nuclear reactors in France are now under repairs. Of course, that's not bad luck. They're under repairs because they have not been investing in them for the last 20 years, etc. Now, what is the consequence? I mean, this you know all, but what is the consequence of this for the economy and particularly for an investor? Well, the first consequence, and I don't want to extend myself because, of course, there are books written on this, and I mean, it's not worth it, but energy is GDP. If you personally are wealthy, it's because you control more energy than somebody who is less wealthy. Energy means having slaves. It's been calculated that the amount of energy that the US citizen uses in terms of actually doing things like taking you to another place, which we do with a car, of course. In the past, you know, the king would sit and then 4 guys would take him to the place. Now we found that cars are more convenient. But if you translate the amount of energy we use and that the king didn't have to people, which is the only thing that the king had, we have about 75 slaves working for us in the rich countries. That's why we're so rich. We have 75 people working for us who demand a 0 salary. When you go to a poor country, they do not have slaves, so they do have to do everything by themselves. So if they want to go to a place, well, nobody takes them there. If they want to eat, well, there's no food because there is no refrigerator, so the little food that there was is rotten, etc., etc., etc. And in this chart here, well, I mean, there are 1,000 charts like that one, but you see that the correlation between energy use and GDP is a very close one. Now, this is not because the richer people use more energy, like the rich people use more perfume. No, it's because they are richer because they use more energy. Which has an immediate, if you accept the statement, the causality going this way, the next statement is immediate. If there is less energy, there is less wealth. And there is no way around that. Now, we don't have enough energy because we have less energy, both in relative terms, because people keep increasing. We're going from 8 billion people to 10 billion people. The very poor people want to use more energy. So we don't have enough increase in energy. And then with these short-term things, we even have less energy than before. So you can go to the next slide. You can cut it any way you want, but we are poorer. I'm not saying we are going to be poorer. I am saying we are poorer. It's like if somebody had come overnight and had taken some of your Bitcoin's keys and they're gone forever. Well, it's the same thing. It is the same thing. Can go to the next slide, please. How poorer are we? Well, if you take a country like Italy or Spain, or almost any European country. France is a bit different because they still had a lot of nuclear. The increase in the energy imports will probably, the increase, amount to about 2% of GDP. So you're taking a country, 2% is a relatively strong recession. Well, you take 2% of that GDP and you send it to whoever is selling you the energy, which is mostly Russia and Arab countries. And that's it. I mean, you are taking that money and giving it to somebody, so you don't have it anymore. This is a slide here, a bit complicated, but doesn't matter. I don't think we have to get into detail, but the fact is that, I mean, it's intuitive. If a family, which is kind of a middle-class family, used to not really saving that much, basically spending whatever they earn, now they have to pay 300, 400, 500 euro more per month in electricity. Of course they can do it, but they cannot take a weekend in Barcelona anymore. I mean, that's over. So tell that to EasyJet and to the hotels in Barcelona. I mean, this is extremely contractionary for everything that has to do with disposable income, which is a very big part of the economy. And this is going to happen. And this is going to be aggravated because, as Marcos was saying, well, if energy is too expensive to smelt metals in Europe, Europe has basically now stopped its metal industry, metals. So there's no more aluminum being made, no more zinc, no more copper. Well, you may think, yeah, I don't buy aluminum any day. Who cares? Well, yeah, you are absolutely right. But that is 10,000 people on the dole. Now, 10,000 people who are going to now get unemployment subsidies. So you are going to see, like we saw in 2008, an explosion of government spending, which is already being, as we speak, announced, which means big debates about the European Central Bank. What do they do? Are we going to get inflation? They shouldn't save the Italians. Now, fortunately, it's Germany now which is in trouble. So in that way, the whole thing gets a little bit better spread. No, it's not only the bad Greeks who are doing the stupid things. So we're going to have very little disposable income. We're going to have many production activities curtailed because there won't be energy to use it. We're going to have immediately government intervention. Now, the interventions we see now are the predictable ones. So you subsidize the consumer because they're hurting, and you take the money from the producers because everybody hates them. So think of it now as an economist. There is not enough energy, so you subsidize demand and attack supply. That is the best solution to make the situation last as long as possible. And then we have political unrest, because then the populist parties come in and they will start saying, look what the European Union has given us, and NATO, and that creates tensions, obviously. That creates tensions, and then the risk premium in Italy and the Italian bonds goes up, and the markets gets nervous. So you are going to see very bad, I think, developments in the markets, because all this is I mean, nothing of these things are deadly, but they make people nervous, and markets do not like nerves. So this is for the medium term, and there is no way around it. I mean, I'm getting now older, little by little. I used to be about the youngest in the groups, and now I am about the oldest in the group. So some of you can still think about the 70s. Well, this is looking a lot like the 70s, a lot, with its wars, energy crisis, I mean, a lot. And then we'll have a slide later on what happened. Now, long term, of course, things will change. I mean, human beings are not stupid. We've been around for about 500,000 years. We've seen worse things than this. But, you know, there is friction. There is friction in between. Now you see Korea has said that they are not going to invest more in renewable energy, and now it's all nuclear from now on. Japan is now restarting things, blah, blah, blah. California, which is where the brilliant idea of killing nuclear started, has now decided to prolong the life of its last nuclear reactor. So things are changing. How do you invest in this situation? Now, every investor I know, when presented with this, sells everything and the hell with it and goes to play golf. Well, that may not be such a good idea, because look at the red bar on the right. Look at what happens if you are in the 70s and you put your money in cash. Well, you end up with 40% less than you had before. So it's probably not the best. I mean, you sleep well because you keep having the same amount of money every day. This is the good news. The bad news is every day you buy less with that amount of money. Now, what worked in the 70s? Well, there you are. This is after inflation, of course. So I think they are very interesting. I mean, the way, this is very generic, to obtain excessive returns in the market is theoretically very simple. You have to find stocks that do not discount all the money they are going to make. Of course, to find a stock that is going to make an enormous amount of money when everybody knows it, we know it's unprofitable. So you have to find things that are going to do very well, but people do not think are going to do very well. Now, for instance, energy companies, mining companies are among the most shorted companies in the markets. People hate them. Nobody believes them. You take any analyst model, and the profits of Cenovus that Marcos was mentioning are extremely high, because they are. You cannot deny them. They're happening today. But when you look at the expectations for profits 3 years down the road, they're lower. They are implying that energy prices, commodity prices are going down. And the prices of the stocks reflect, obviously, that discounted cash flow. Well, let me tell you one thing. If they do not go down, well, you are going to multiply by 5 if you invest in these things. So it is the worst possible scenario for an investor, because it's very easy to make mistakes. It is the best possible scenario for an investor because there are opportunities. When everything is fine, there are no opportunities. There are no opportunities to make mistakes. Here, there are good opportunities. One has to be careful. Governments are going to intervene much more than usual. So think where you want to, I mean, if you invest in energy, they're going to hit you with windfall taxes. That is a fact, which means that instead of multiplying by 5, we will multiply by 3, which is worse than 5, but better than minus 40. So you have to take all these things into consideration. And there are very interesting things. There are some potential things almost in the realm of venture capital, in geodesic electricity generation, of course, in nuclear fusion. There are very interesting developments which are not investable really, but yet. But that will have to be followed very clearly because they can completely change. But that's going to take 5 years, 10 years. So for the next 5 years, if you do not remember, try to find a good book about the 70s, and because you may be reading tomorrow's newspaper today, actually, which is the best thing that an investor can do. Okay, thanks for your interest.
Hey, thanks a lot, Carlos. I would like to wrap it up very, very briefly. By the way, just a final remark on what just Carlos said. In the 70s, value was doing pretty well. And here we are looking at the see-through profitability of the Classic that we updated at the end of July. And you see basically our portfolio, our total holdings together, as if it would be one company, trades at 10.4 times earnings 2022, 3% dividend yield, and 1.6 times, 1.8 times, sorry, price to book, which is substantially cheaper than the markets on all these ratios. And if you go further out, you see that we are actually trading below a P of 10 pretty soon. Now, if you look at the 20 years chart of the performance, we are compounding at 8.6%. What you clearly see, what Carlos and Marcos mentioned, this power of anti-cyclical rebalancing that we're able to do by reducing our category 1 and 2 stocks and buying 3s and 4s is extremely powerful. Over the last 10 years or 11 years now, time is running, we have achieved 10%. And last but not least, I would like to show a couple of slides on the natural resources theme, because a lot of investors are asking us, is the mining space already done? It's correcting now. If you look at this very long-term relative ratio of mining stocks relative to MSCI World, and I'm a strong believer that this is mean reverting very, very long-term. It can easily double or triple from here, and we would be just in the middle. Energy, exactly the same, and we strongly believe it's going to happen, and we make the case that we're going to see a repetition of 2001 to 2011. That's the large chart that we're going to show. It's basically the performance of the natural resources fund relative to the index since the COVID low. Again, here, I think this power of anti-cyclical rebalancing is massive. And we really think it could be a very interesting puzzle to play, a potential hedge against your purchasing power that you want to really protect against inflation, and you want to keep enough cash for your retirement. With that, we would like actually to go on now to the questions. There was one question already sent by chat. That was more on this topic that Carlos was talking about, which was on this subject of is there enough cash still for disposable income? And there's another question on Grifols. Maybe we start with the Grifols question, and the person who asked this disposable income question can put again a chat, because I think Carlos already answered his question, but if he has a follow-on question on that disposable income, he could easily put a chat again in. And then I would like to pass on to Marcos, because we had a question on Grifols. How happy are we with this company, because it seems to be indebted? What is your comment, Marcos, there?
Yeah, we are buying Grifols slowly, patiently. There's basically two main issues, in our opinion. One is the management, which is a little bit, tight. It's a family company, it's a family-run business, so the family is slowly progressing towards more attention to minorities. This is an issue. It's being done. There's a strategic shift. There's changes in the management. It will not be fully changed, but we are fine with that. The second issue is the balance sheet that is geared, but they have a plan. We have tested the plan. We have spoken to them, and in our view, they will deleverage very rapidly in the next 2 to 3 years. The main problem for us, and we did a due diligence 2 years ago, was the business itself, meaning competition or competitive products against the plasma products they have, the plasma proteins. And after the due diligence, which was very intensive, we didn't find any change in the competition framework, which means that the business is very, very, very solid. They don't have really competitive products that can damage the business structurally. Finally, one comment on the blood collection in the US. It is true that there is cost inflation. It is true that the COVID-19 has kind of damaged a little bit the business, but we expect that this will normalize in the next 2 years with more immigrants and lower prices, maybe not lower to below pre-COVID, but more normal prices. So net, as the business, we think is fantastic, high entry barriers, good margins, blah, blah. We think that debt and management are issues that are now secondary. Management is improving, maybe not to the level we would like to see. And balance sheet, if the business goes well, it will naturally de-gear.
We just got another question, Marcos, maybe for you. Have you already taken into consideration if Iran would be back with 200 million barrels per day?
If the
200,000 barrels per day must be, yeah.
What?
Would, if you look at the chat, you see the question. It's basically on Iran. What would be if Iran would come back? Basically, if there would be an agreement reached with the US, I suppose. How is that impacting our view on the oil price?
Yeah, Iran, on our numbers, Iran has a kind of theoretical capacity, total capacity of 4 million, which is not really believable, but is what they say. Now they are selling around 1 million. If there is an agreement, it would be 1 million more to be kind of short term next year. So 1 million would have an impact, but OPEC Plus has already done a statement, or they are saying that they're going to manage that. So I include more or less Iran in my numbers because OPEC will manage this flow. However, I mean, 1 million, the elasticity is more or less historically is 15%. So 1% of new capacity would take prices down 50%. So if nothing happens and Iran really reach an agreement and takes 1 million out, prices should fall around 15%. But we think that OPEC will manage. So it's a short-term thing. There's something that we don't mention too much is that jet fuel is very low. So if the business, if excluding the recession, if flying normalizes, there's still a gap of 2 million barrels a day to be filled only with normalizing flying. So, you know, we are not very scared about this. 15%.
Thanks a lot, Marcus. Urs wants also to add something.
Yeah, maybe, you know, it's a bit the same discussion like also we have in Russia. I mean, people shouldn't forget that 80% of the world has no sanctions, and I'm always laughing that, you know, this country is still selling their oil. I mean, even if they don't sell it into the West, I mean, it's still getting sold, and we all know by day these headlines about India, about China, and you know, this is a global market. Just because the West has some sanctions on some stuff like that, it still finds the market somewhere, and obviously that has issues more on the transport and logistics. And storage, you always have storage, and this is also a question about the forward curve. But I think it's completely, you know, misassumption to assume just because some Western countries, you know, might not want to buy oil, particularly in the case of the US, which obviously is so far away, but the oil still finds its way to the market. So sometimes I think these effects are much lower than people expect. And in the case of Iran, I mean, this is officially said since, I don't know, since I'm living nearly, that they sell to India and to China, and they don't care about what the US says. And so I think this impact might not be that big.
Thanks a lot, Urs. Marcos, there was a question on ING. Can ING be a value trap?
We don't think so. We don't think so. ING is super cheap. It's trading at 0.7, even 0.6 times to book value. I think the fear with ING is a recession fear. So I think in Europe, there's a lot of people fearing a recession, you know, with Germany going down in the next year. And this is, you know, people just, the correlation with banks, high beta to recession fear is very, very high. I think we think the bank is super strong. The balance sheet is very clean. They almost bankrupted they bankrupted in the past crisis, and everything is clean. They are super conservative in the management. NPLs are doing fine. Credit is doing fine. You know, basically it's mortgages. Half of the book is mortgages, and really the loan book to non-mortgages is super diversified. So really you find difficulties to get problems for this bank. So in our opinion, this bank can go lower in terms of price. Yes. Maybe 0.5 will be the low. I think from memory in the past cycle, 0.4, 0.5 is the low. We see zero, very, very little problem, fundamental problem from the bank. So we will keep buying. If it goes to 0.5, we will buy. And then in the next cycle, these things will go back to the normal levels, because return on equity, return on tangible equity targeted with from the management is around 12% in the next few years. It should be trading at 1 or 1.2 times book minimum.
Thanks a lot, Marcos. I think we now passed the hour and we don't want to spoil everybody's time too much. Thanks a lot. We had 60 persons on the call. It was a pleasure to talk to you or to see you. We have a big agenda in front of us. whoever is in the reach of basically Zurich should look at maybe at our natural resources invitation that takes place next Friday. Next Wednesday and Thursday, Urs and me are in Munich and Stuttgart. And then on the 22nd of September, the whole team will be in Frankfurt. And towards the end of the month, on the 29th and then the 30th, we will be in Köln and Hamburg. Please feel free to call us for every question that you may have. We can also do an individual Zoom call if you like, because we think it's very, very important to have a direct line to our investors. And we are very, very pleased to have you all with you. Thanks a lot and have a good day. Take care. Bye-bye.